Hello, and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today, we're going to be talking about uh, accounting for receivables, including accounts receivable. Before we jump into today's discussion, I'd like to first and foremost thank all of you for completing the mid-semester survey. The mid-semester survey, which took place right after your midterm exam from last week, was very helpful for both you and for me. Uh, a lot of results came out of that survey. The vast majority of you had commented that you wanted to see more examples, exercises, the ability to have things like breakout groups, additional text material. Um, all of your comments on that mid-semester survey were extremely valuable to both you and to me. The reason for that is I'm able to make pivots halfway through the term, halfway through this course, in order to help you to better understand the content. That's the whole idea of a mid-semester survey is it allows us to have that flexibility, right? And so I had sent out a message to all of you today recapping on what we learned from that mid-semester survey. So in taking a quick look at that message I sent to all of you, the three primary strands, the three takeaways from the mid-semester survey, these came from the majority of your comments, right? Because I read through all of your comments. I looked at it from your perspective, and I want to tell you that I take your feedback extremely seriously. And the point of this mid-semester survey is allowing us to pivot our class a little bit based off of your feedback, because I strongly believe in a couple of key core values. One of those is called shared governance. Shared governance is where we all take responsibility for our actions and for our course. And so your feedback helps to drive this course. So a couple of takeaways. A lot of you, and I mean like probably 90% of you had said you want to see more examples, exercises, and discussions around the course content. I wholeheartedly agree with your comments. So here's what I've started to do already. And I started this morning after reading all your feedback. I have some material that I acquired over the years, right? And so, in order to help you in that concept, I found a bunch of exercises that I've used in the past that have worked well. And so I brought them into this classroom. I've also gone to other resources on the internet that I'm aware of, and I pulled some material from there as well to provide you with additional exercises and examples. And I'll show you where that is in the classroom here in a second. The other thing is some of you are interested in that's a misspelling, breakout groups. Yeah, we can totally do that. And what I'll do is we can set up that opportunity on Blackboard as well. And we could also have small discussions during our lectures. And the third biggest takeaway was you're interested in additional supporting materials, books, internship opportunities, job opportunities, so forth and so on. And so I've started that process as well in the classroom. So let me go ahead and show you where we've made enhancements to the classroom based on your comments from the mid-semester survey. So if you go into the Blackboard classroom and you start going to course content, you start to scroll down, you're going to automatically see one of the newest components here. It says accounting major student resources. For those of you who are accounting majors and you're interested in working in the accounting field, this is for you. Additionally, if you're not an accounting major, but you're interested in the accounting field, this is also for you. So if you go ahead and click on that, I've started the process of gathering a bunch of resources for you. One is internships. These are all current internships. Wonderful website, internships.com. provides internship opportunities throughout the nation. Here in Washington, D.C., there are very specific location internships available. We have a career paths website. So for those of you who are looking to progress in a career within accounting, this is a wonderful website for you. And third but not last is your LinkedIn profile. For those of you who do not have a LinkedIn profile currently, I am strongly, and I use the word very strongly, strongly encourage you to create one. Even if you have nothing to put on there, the amount of resources available on LinkedIn are immense. You'll be able to expand your network of professionals, talk to them about their experiences, grow your network of professionals, and ultimately, the best way to find work opportunities in this world, from what I learned personally, is through people you know. Through people you know provides you the best opportunities. And that's what I found is, yeah, you can look for jobs and apply to jobs and so forth and so on. But I will tell you this much, when somebody refers you to something, that goes a long way. And so for those reasons, if you haven't already, I would like to strongly encourage you to create a LinkedIn profile. I think it'll be very beneficial for you. In addition to that, they have wonderful job opportunities that they post on there all the time. And it's also a great networking opportunity. Do not think of this as a social networking platform. It is definitely not that. This is not a Facebook. This is not a Twitter. This is something completely different. It is for professionals, professional stuff only. Okay. So I strongly recommend you please take advantage of LinkedIn. And that goes for all of you, not just for accounting students. So that is one resource that I'm building up for you all. In addition to that, you had said, and this is probably the most important one, you want to see examples, you want to see exercises. I'm with you on that. Okay, so if you come down to module 3, and I literally just started creating these today, okay? So if you come down to module 3 and select week 5, which is where we are currently, and we're going to be talking about receivables, accounting for receivables here in a second, which is chapter 9. If you'll see a new item, and I literally just created this item not more than 40 minutes ago. It's called Chapter 9 Exercises. So if you click on this Chapter 9 Exercises, I got you a bunch of different Excel documents, okay? These Excel documents are exercises. So if you download the file, opens like this. And we can see what this one is all about already. It's journal entries. So we can select a debit account, select a credit account, debit, credit, couple of questions, true, false. These exercises I have obtained from a really great resource. It's called principlesofaccounting.com. I know, right? The website sounds funny, but it's based off of a set of professors that teach principles of accounting, like myself, and we create learning resources for students around the world. And these learning resources have a lot of exercises, right? They're not graded. They're just there for you to get more experience working with this information. So I think it's a good start. Hopefully you all feel that's the same way. So feel free to download them, save them, do whatever you like with them. But they're there for you, okay? So I got you a bunch for Chapter 9, and I got you a few more for Chapter 10. And I'm going to do that for the rest of the course, okay? Again, the objective here, these are just exercises. They're there to help you to further learn the information by practicing. That's what exercises are, right? They're practice. And very early on, probably the first lecture we held together is I had said that accounting is a practice. And you all your feedback on that mid-semester survey. I tell you what, it really opened my eyes to what you all are asking for. And so that's why I, I sincerely appreciate all of you taking the time to complete that survey, because again, with your feedback, I'm able to improve our course as it's happening. Yeah. And so hopefully you all see that. Uh, I seriously do take your feedback very, very seriously. And my promise to you is I will continue to improve the course based on your feedback, and I'll also continue to improve my teaching style based on your feedback. Any questions?
Professor,
Yes.
can I just say something?
Yes, please.
I just want to say thank you for all the resources that you provided based on our feedback, and also thank you to my classmates, whomever has, put in like internships and, jobs. I really appreciate that. Thank you.
Yes, thank you. I appreciate your kind words. Yes, thank you. Thank you all. Again, hopefully, the intention here is to help you all, and that's what my job is. My job is to help you be successful, and I will go above and beyond my job to make that happen. And again, if any of you are looking for work, you're looking for internship opportunities, please reach out to me. Send me your resume. Just email it to me, and I will also reach out to my contacts in the industry. So, but thank you all. I appreciate it. And again, if you ever need anything like that, you just let me know. Okay. Okay, great. Let's go ahead and get started with today's discussion on receivables, accounting for receivables, chapter 9. Those of you following along. All right. So before we start, let me ask you this: what is an accounts receivable?
Is account receivable is when a customer owes a company.
That's right. Yeah,
Yeah.
that's right. So we made the sale to the customer. The
Hmm.
customer now owes us the money from that sale. In other words, they did not pay us at the time that we delivered the good or the service. They will pay us within X number of days, right? So that, yes, that is correct. That's an accounts receivable. What is a notes receivable?
Notes receivable is with the interest.
Yes, it's with interest. That's correct.
Yeah.
So there's a concept we'll talk about with notes receivable. What happens is when a customer does not pay us after a month, after 2 months, after 3 months, 30, 60, 90, 120, 180, we don't see the customer for a while. They keep saying they're going to pay, they never pay. So one thing that businesses oftentimes will do, well, there's a couple things. One is they'll send it to what they call collections. Collections can either be an in-house operation or a third party. What happens is they attach interest to what is owed. And that interest is a form of a penalty, right? And that is the concept of a notes receivable, is they'll convert their accounts receivable to a notes receivable, attach interest, and then later collect. That's one form of notes receivable. Another form of a note is from a loan, and we'll talk more about these things. But those are the two primary types of receivables. So we'll talk about how they're recorded, what the journal entries look like for receivables. We'll talk about things like maturity date, uh, if it's a note receivable. We'll talk about things like write-offs when we can't collect on our receivables, and we'll also talk about uh, methods to estimate uncollectible receivables. So let's take a look at our first part. A receivable is just as Awas said, it's when someone owes the company money from a sale that we made to them. lot of companies, and I would say a lot of the large companies especially, carries a large portion of receivables. What that means is they make a lot of sales on credit to their customers or on account to their customers. When a company makes a sale on account to the customer, that simply means I have delivered the good or the service to the customer and I sent them a bill. They have not yet paid me for those goods or services. They will eventually. That's an account receivable. Companies have a lot of customers, as you would hope, right? So let's say you have a company and you sell to multiple customers on account, meaning accounts receivable. There must be separate accounts for each customer in order to track how much that individual customer has purchased and owes you and what they've already paid. That's how we track how much each individual person owes the company. So we've talked a little bit about this, and it's through the concept of subsidiary ledgers. A subsidiary ledger is a ledger within a ledger. The primary ledger is accounts receivable. The subsidiary ledger would be the name of the customer, account receivable. In this example, we have a couple of different companies. We got John Deere, Callaway Golf, Pfizer, Abercrombie Fitch. I think they're all still in business. They are. I know they are. We can see that Callaway Golf, 16% of their total assets is tied up in accounts receivable. That's high. That's a lot. John Deere has 5.2%, Pfizer 4.8%, Abercrombie 4.1%. What this shows us is the percentage of total assets that are in accounts receivable. In other words, the rest of their sales that they made are cash. Accounts receivable makes up the other amount of sales, right? And percentage-wise, we want to keep accounts receivable at what we would call a healthy range. And this depends on the company's industry, what the industry standards are, what the industry averages are. Some industries have higher accounts receivable averages than others. But I would also say that typically you would want an accounts receivable percentage to be 10% or less. The reason for this, if I have too much of my sales tied up in accounts receivable, that means I don't have a lot of cash coming into the business. Do you see what I'm saying? If I make a sale on accounts receivable, I'm not going to see the cash for 30 days possibly or longer. And businesses need cash in order to operate. So maintaining a good amount of cash flow, very, very important. Let's look at the journal entries. When we make a sale on account to a customer, you all know that we debit accounts receivable to increase the account receivable, and we credit sales. Let's think about this for a second. The reason why we debit accounts receivable to increase it is because, as you recall from the first chapter, maybe a second, is that accounts receivable is an asset account. To increase an asset account, we debit the asset account. And the reason why we credit sales to increase sales is an equity account. It falls under equity. And equity accounts, to increase the equity account, we credit. So the first transaction we have here is we sold $950 of whatever, something, electronics, I guess, to I'd say CompUSA. They've been out of business for years. We'll say CompUSA. And a collection of $720 from RDA. So there's two different transactions. The first transaction, we're selling to our customer on account. So we debit accounts receivable to increase accounts receivable for that customer, and we credit sales to increase sales. The second transaction of the day is we are receiving cash from one of our other customers who owes us from a sale we had made in the past. So we would debit cash to increase our cash, remember cash asset account, and we credit accounts receivable to reduce the account receivable for that customer. Now you'll see that it says account receivable dash comp store, account receivable dash RDA electronics. These are the names of your customers. The name of the customer dash account receivable, that represents the subsidiary account within accounts receivable for that customer. Because earlier we had said we need to have individual accounts for each customer within accounts receivable.
Professor, can I ask a question?
Yes, please, Mark.
So when you saying, okay, when you're debiting an account, so you're saying on here, it shows account receivable comp store, 950.
Mm-hmm.
And then it says sales, 950.
Mm-hmm.
And then how you read it was credit accounts receivable is an asset account.
So accounts receivable, you're on the right track. So accounts receivable, as you recall, is an asset account. It's an asset account because we are going to be receiving cash from a customer. Cash is an asset, right? Accounts receivable is an asset because we own the rights to those accounts. We own the right to collect those accounts. That's why they're asset accounts. To debit an asset account means to increase the asset account. So in this first journal entry, we debit accounts receivable to increase the accounts receivable, and we credit sales to increase our sales. The second transaction, we debit cash to increase our cash, and we credit accounts receivable to decrease accounts receivable. So when you debit an asset, we're increasing it. When you credit an asset, we are decreasing it. Does that help to clarify your question, Mark?
Yes, it does.
Wonderful. Thank you so much. Great. Let's look at a few more. So we went through these two transactions already. On the bottom of this particular slide, we can see the overall effect on the ledger. As you recall, we have a general ledger and we have subsidiary ledgers. The general ledger reflects the parent account. In this case, we're looking at accounts receivable. Within accounts receivable, we have the subsidiary accounts, which are shown on the right. These represent the individual customers' accounts. Okay, so think parent account, that's the general ledger account. Subsidiary accounts, those are the children that belong to the parent, right? That's one way of thinking about it. I think of like a tree, right? It's like a tree. At the top of the tree, you got accounts receivable. The layer just below it, you have your subsidiary accounts. Those are your individual customers. Now we can see that the general ledger balance, 3,230, includes the two transactions from above. Make sense? Just kind of shows you graphically, right?
Professor.
Oh, wow. Yes.
The accounts receivable ledger, those are the subsidiary, right?
Yeah. So
on the right side.
Yeah, on the right side, those are subsidiary accounts. That's correct.
Individual accounts. Okay.
You got it exactly. Yeah,
Thank you.
very good. Awesome. Wonderful. Oh, okay. Another fun topic. Sales on a store credit card. Okay. Now, some time ago, we had this conversation. We talked about making sales on a credit card. And I had said, and you hopefully you recall this, credit card sales are the same as cash. A check, that's the same as cash. A credit card, same as cash. Cash is cash, right? It's all cash. Okay. Now, hopefully you know this. When a customer pays you using a credit card, you still collect that amount in cash. However, there is a fee involved. There's a fee. It's called a credit card fee. Okay. When you go to the store, let's say, or a restaurant or wherever, let's say you go somewhere. Okay. This weekend you go somewhere. Like, oh, let's go on a night on the town. Okay. The store owner or whatever might have a policy that says, oh, all credit card sales, you must purchase $10 minimum. Or you might see something like credit card sales receives an additional 3% charge, whatever, right? The reason for that is because if you are a retailer and you accept credit cards, the credit card companies issue you a fee to accept that credit card. So in other words, the vendor, the sales, the company charges, they get charged a fee for accepting credit cards. And it's usually a percentage of the sale. And we're going to talk a little bit about that over the next few slides, but I want you to get that basic understanding is that every time a card gets swiped, there's a fee. That fee is the responsibility of the store owner to send to the credit card company, the processor. It's a processing fee. Those processing fees add up. They get very expensive. That's why a lot of companies either don't accept credit cards as a form of payment, or if they do, there may be an additional charge involved to the customer. And we're going to talk about those instances. So looking at this first transaction, on November 1st, the company recorded sales of their own on their own credit card in the amount of $1,000. Some stores have their own credit card. An example of that would be your Macy's store card. Oh, Mark, I know you love the Macy's or the Neiman Marcus or the other ones, right? And those, Mark, they got
It's Macy's and Bloomingdale's.
what's that?
I said it's Macy's and Bloomingdale's.
Bloomingdale's. Thank you for the reminder. Yes. So Macy's and Bloomingdale's, they each have their own store card. And people will go to the store and they'll make purchases on their Bloomingdale's card or their Macy's card. Now, the store makes out on this deal. Okay, well, here's why. So, if a store issues you credit, meaning, hey, come apply to my card, the TJ Maxx, the Maxxanistas out there. Oh, apply to my TJ Maxx card. Oh, apply for my Macy's card. Oh, apply for my Best Buy card, whatever, right? It's a store card. When you apply and you get approved, when you go to charge something on that card, you get charged this thing called interest. Vince, go ahead. Miss Marshall. You okay? All right. So you charge your card, you get charged interest on your purchase. That's why store cards get pushed heavily at the store, because that store is also earning interest revenue. Okay, so you made a purchase, or a customer made a purchase using their store card for $1,000. We debit accounts receivable and we credit sales. Debit accounts receivable, because the store card is a form of accounts receivable. The customer hasn't paid the store card yet, so we debit accounts receivable. And then we credit sales, $1,000. On December 31st, we charge that customer interest on the remaining balance. In this case, 1.5% per month on the seller's credit card, on the seller credit card. So in other words, we, the company, we're charging our customer 1.5% every month that the on store cards that are past due. So we debit accounts receivable $15 to increase that account receivable another $15. And we credit interest revenue $15. Interest revenue is a revenue account, which is a sales account essentially, but it's other sales. Okay. Interest revenue is interest that this company is receiving from their customers when the customer uses their store card to purchase stuff in the store. Does that make sense?
Yes, it does. And I have a question, Professor.
Yes.
So how long does it take for the interest to, for them to charge you for the interest? Is it like when you purchase?
Yeah, good question. It depends, right? Yeah, so it depends in the agreement, the card agreement. Some companies, they'll start charging you interest right away. Some companies, they'll wait. They'll give you the interest-free deal for 30 days, or it'll be interest-free for the first year. Interest-free on your first purchase. You know how they advertise those things. So it depends is the answer. So not all credit cards are the same, right? And it depends on the credit card agreement. But in most cases, there's typically always an interest rate. And it's usually a lot higher than 1.5%. It's more like 19%. Just give you an idea. But yeah, to answer your question, it depends in the card agreement. Good question.
Thank you.
You're very welcome. What about this? What about the when they go to pay? Okay. On July 15th, I got distracted. On July 15th, our company has $100 of credit card sales with a 4% fee. I hate the fee. And it's in other words, we received $96 in cash, and we got to pay a 4% credit card fee to the processors. Okay. Earlier, I had said, when a customer comes to our store and they swipe their card, not our card, not the store card, someone else's card, a Visa card, a MasterCard, an American Express, or whatever. Okay? They swipe the card. Okay? The retailer has to pay a credit card fee for every swipe of the credit card at the credit card machine. So let's say you go to Giant Food. Okay, you go to the grocery store. or you go to Wegmans, or you go to whatever, Safeway. You go to Safeway, you buy your groceries, and you swipe your debit card or your credit card or whatever card. You swipe the card. With that swipe, let's say your bill's $100 in groceries. You swipe the card. The store don't get the whole $100 in their account. They get 96. Why do they get 96? There's a 4% credit card fee. So that's 4% of total sales of that total sale. So if the total sales total comes to $100, the store will receive $96 in cash. There's a $4 fee because it's 4% of the total sale. So we debit cash, $96, because that's how much cash we actually got from that sale. We debit credit card expense. Credit card expense is an expense on the income statement. The credit card expense account is used every time we swipe the customer's card. The customer swipes a card, there's a 4% fee. That fee gets allocated to credit card expense. And we credit sales for the total. Now you can see your debits still equal your credits. Debit $96 in cash. Debit $4 credit card expense. Credit sales. Any questions? Does it make sense?
So basically, when you make a purchase with a card and it has a fee like this, the company is really not winning because they still have to pay for that expense, correct, for the credit card?
That's right. That is 100% correct, Marina. So the company still has to pay that fee, right? So that's why, Marina, you'll see that some companies, they don't even accept credit cards because of this, because of the fee.
Yeah, and then I see why now they have like the minimum of $10 because of this.
Yep, exactly. And that's very, very true. Yeah, 100%. Yep. And that's the same with any credit card. It doesn't matter where you are, right? There's that vendor still has to pay that fee. You could be at a farmer's market and the farmer accepts debits and credit cards using the what the hell is that thing called? The Square. It's like a card.
Oh, Squarespace?
Yeah, Squarespace. It's like a portable card reader. They swipe your card, right?
You're talking about Square. I know what you're talking about. I know what you're talking. It's Square. It's
Oh,
like
it's
a small.
Square? Okay.
Yeah, Square. Yeah,
It's basically a small thing. And if you're, because my barber uses it. You can swipe your credit card, and the money automatically goes into his account. So it's like uh, it attaches to your phone. You have to download the app. I know what you're talking about, Professor.
Yep, that's exactly right, Mark. So what happens is you go to the farmer's market, you got your card with you, you forgot your cash. Hey, no problem. You go to the farmer sells you the stuff. They swipe your card using this thing called a square. The square attaches to the phone. He swipes the card or enters the card number into the phone, and it charges your card. Bad news is the farmer still has to pay the 4% on the transaction to the credit card processing company. So it doesn't matter where you are. If there's a swipe of the card, there's a fee involved to the vendor. That's one of the drawbacks with accepting credit cards. Okay. We'll talk more. We'll continue talking about that because it's always interesting. And one other thing I'll tell you from my personal experience, when I had my small business, I used to accept, and I had the Square. That's actually how I knew about it. Is I would accept, debit and credit cards. So on average, and this was several years ago, so I'm sure the interest rates have changed, or the expense, the percent expense has changed. So it used to be, this is many years ago, so I'm sure it's probably a lot higher now. For every MasterCard or Visa, my expense was 2.5% of the sale price. Okay. For American Express, it was 7% fee for American Express. That is why a lot of times you'll go out to a place, they'll say, we don't accept American Express. They'll accept Visa, MasterCard. They won't accept American Express because the fees are a lot higher. So the point that I'm getting at here is the individual credit card companies set their fees. Or Discover, exactly, Marina. The Discover card, another classic example of a higher fee. And sometimes the vendor might say, we don't accept Discover card, we don't accept American Express, because their fees are higher. Another example, let's say you're a Costco member. You go to Costco. I go to Costco, that's how I know. You go to Costco. Costco only accepts Visa. They do not accept MasterCard. They do not accept American Express. They do not accept Discover. They only accept Visa. Why is that, you might be wondering? Well, the real reason for that is they worked out a negotiated fee with Visa, okay, that is lower than most other places. So that's why that's the case for Costco. Just an interesting fun fact.
That's why the saying is Visa is accepted everywhere.
That's right. That's right. Isn't that a good slogan? Yeah, I love it. Very cool. Okay. Sales on installment. Installment. An installment simply means that the customer pays a fixed amount every month or every time period. Okay. And then that's what an installment is. Think of like you have a car and you have a loan on your car, a car note, and you have to pay the same amount every single month. That payment that you're making every single month, that's called an installment. At least on the business side of things, it's called an installment. And that installment usually includes the principal balance plus interest. It's the same with a mortgage. It's an installment, right? It includes the interest. So amounts owed by the customers from credit sales, which payment is required on periodic amounts over an extended time period. These are the customers usually charged interest. If you have a credit card and you pay it monthly, that payment that you make every month includes some amount of principal balance plus interest. That's an installment payment. Yeah. My recommendation, stay away from credit cards altogether.
I have a question.
Yes, go ahead, Mark.
So let's say, for instance, you apply for a credit card where you're putting money on the card.
Sure.
Just hypothetically speaking, you use like, okay, you put $500 in this credit card.
Okay.
So when you put the money on and you spend like $200 off of it, when you pay it back, you're paying back the principal and the interest, or just the money you spent?
So it depends, right? And it depends on the credit card agreement. So if you let's say Mark applies for a credit card and we'll say it's a MasterCard or whatever, and what'll happen is when you apply and you get accepted or approved, they'll send you a pamphlet in the mail or email or whatever, and it'll explicitly say the interest rate. And the interest rate will say something like 17.99% or 21% or 27% or whatever, right? And with credit cards, typically, I'm talking about the personal side of things, not the business side. With credit cards, typically, is the interest rate compounds daily. Daily. Okay. So when you're making your quote unquote minimum monthly payment, in most cases, you're only paying the interest. You're barely touching the principal. Uh, and that's the case with most credit cards. So that's why I strongly oppose credit cards. I just want to make that very clear. From a personal side, I oppose credit cards. From a business side, I'll accept them all day long. But on the business, I'll accept credit cards all day long on the business. But from a personal perspective, stay away from that stuff. It's dangerous. It's dangerous because it costs you a lot of money. Make sense?
Yes, sir.
All right, stay away from credit cards. Yeah, I have I have a credit card. I have a few of them. I rarely ever use them. The only time I use them is when I'm traveling and staying at a hotel. But then usually what I do is I pay it off right away, so that way the bank doesn't get any interest. I and it's more for security reasons, right? So like when you travel, if you go to a hotel, for example, uh, you can use your debit card, but they'll put a huge hold on it, right? And that hold prevents you from being able to spend your own money. So that's why it's better to use a credit card when you travel, but make sure you pay it off right away, like the very next day or whatever, because you don't want to get hit with that interest.
I'm glad you brought that up, is because HP, Hewlett Packard,
Yep.
when I used my debit card to purchase my laptop,
Mm-hmm.
the money was there. So my credit union, they put a hold on my account
Mm-hmm.
until that money is released to HP, which is Hewlett Packard.
Sure.
And it took 4 business days for it to go through.
Yep.
Why,
Yep.
why does that normally happen?
It has to do with the processing time. So, and I think I may have mentioned it actually last week.
Yeah, it has something just like how you were saying it's like a pending, like with the PayPal, how
Yep.
their process. Yeah, it just takes them a few days, depending on what system they're using for payment.
Yep, and it depends on when they close the batch out. I think I mentioned this last week, is oftentimes what has to happen is at the end of the night, your company, let's say you're a cashier somewhere, right? At the end of the night, you'll close out your credit card transactions. How do you do that? Well, you go over to the credit card machine, you select the button that says batch out or close or enter or whatever, and what'll happen is the machine will start printing a real long receipt. It's called an R slip. That R slip represents all of the credit card transactions that happen throughout the day. And when you click that button for the closeout process to print the R slip, it will close all of those pending transactions. And that's what takes it a couple of days, Mark, is some places they don't close it right away. Or if you buy something on a Friday, let's say you buy something on a Friday afternoon, the bank is closed. They close at like 4 o'clock or whatever, or they're still open, but they're not. There's no way that they're going to receive that closeout because the vendor won't close out until the nighttime. The banks typically don't process um, transactions over the weekend. Usually on Monday morning, you'll see it finally hit your bank account, and that's
Okay, so now that makes sense. That makes perfect sense. Thank you.
yeah. You're welcome. Great question.
Excuse me, Professor.
Hey Alexis, yeah, please.
My question is, how come with banks and other credit places, there's a fee? Like, why is there an interest fee if your bank account doesn't have a certain amount?
Oh, that's a good question. Can you give me an example?
Say for instance, I was with SunTrust. Well,
Okay.
no, let me go. Not SunTrust. Capital One, because they're like the charging cards.
Yeah, they sure do.
I have only $20 in my account. Okay, it comes around for the bank statement to come, and they charge a $3 fee just because I don't meet the.
Welcome to Capital One. It's time for you to go to a credit union. That's what that tells me. Yeah, banks.
Oh, okay. Thank
Banks.
you.
That's how they make their money.
That's how banks make money. Yes. How do you think a bank stays in business? They charge their customers to use their quote unquote service. So
That's why it's better to go to credit unions instead of.
yes, please
Okay.
switch to a credit union. Get away from Capital One. They suck.
Oh no. I have industrial bank. I don't do that Capital One. That was just the example.
Well, Capital One's the worst offender. but yeah, usually the big banks are pretty bad when it comes to fees. Bank of America, SunTrust,
Yeah.
Capital One, you name it, right? The big national ones, Citibank. I
Yeah.
hate.
Is it because those banks are also like globally known?
That's part of the reason, but they have fees for everything. Okay, that's how they make their money. That like banks make money on fees and interest. That's how they stay in business.
That is true because when I first started with Citibank, you have to keep a certain amount in your. When you open up a checking account, you have to keep a certain amount in your checking account because when they go to pull the money out, they automatically it's taken from you, but they put it into like a savings account, but then it's like they take 2% of the amount that you owe them, if that makes sense.
That's right. Nassim, go ahead.
I was
Nassim.
going to say that I was going to say that maybe I'm misunderstanding the book here, but what you're going to talk about with direct write-offs is this is personal credit on the company. So it's like getting the Home Depot credit card. Because my understanding was if I use a bank credit on Home Depot, let's say,
Mm-hmm.
Bank of America actually pays the company Home Depot directly, and I owe Bank of America.
That's right.
So this is a personal credit, correct or incorrect?
Yeah, personal. That's right. Mm-hmm. Yeah, that's a personal credit card
So,
in that instance.
so I want to make sure that you're talking about this because I know you're talking about banking credit cards, but this example, the direct write-off, is if I, as a company, and let's say it's my company, Nassim Yusuf Incorporated,
Mm-hmm.
that this is someone who used my credit card for my company, and now they cannot pay it. This is not a Bank of America paying because they've already paid me, correct?
That's right. Yep. So this is Nassim sold some inventory to one of his customers. The customer never pays him. Uh, Now all of a sudden you're out of cash, right? So you can't collect it for whatever reason. The customer fell off the face of the planet. You sent them notice after notice. They still haven't freaking paid you. So what you need to do as Nassim's business is you need to write off that amount that the customer has not paid you. In other words, Nassim should not be paying taxes on revenue he never collected. Does that make sense? That's what we're getting.
Yeah,
About to get into.
I think, but this is the advantage of a company like myself to accept bank credit cards because then even if I pay a small fee, I'm going to get my money as opposed to using my own credit card. So in
Correct.
other words, if I'm Home
Correct.
Depot, I would go ahead and pay a $5 fee to Bank of America, but they're going to pay me the money right now.
That's right. Yep.
Whereas if they use my Home Depot for my own company,
They
then
might not pay
that
you.
may be a bad debt I never may
You
see.
got it. You got it. That's 100% right. So in other words, if you let's say you own Home Depot, you got a customer that comes to your store, they make a purchase using their Visa or MasterCard. No problem. You just got paid by that bank all instantaneously. That's great. So you don't have to go freaking chasing down somebody for money. If they use your Home Depot card, they cannot pay you. Now all of a sudden you're out of that possible revenue. Yeah, that's right. 100% right. Yep. So that leads us into our conversation. Let's talk about writing off. Some customers may not pay you, becomes uncollectible. We call that bad debt. Bad debt simply means the customer ain't going to pay you. Okay? There are two methods to writing that bad debt off. And when you hear me say the word write off, it simply means we're taking it off of the books so you are not liable for paying taxes on revenue you did not receive. You earn the revenue, you just didn't receive the revenue. Totally different things. Let's take a look at this. So here's our first example. Our company determined on January 23rd that we got a customer, this guy, Jay Kent, he ain't going to pay us. Okay, he's not going to pay us. So we cannot collect on $520 from our customer, Jay Kent. He disappeared, fell off the face of the planet. Don't know what happened to him. He went out of business. I don't know. All of a sudden, I know that I can't collect his account receivable. Okay, I'm on the hook right now because I can't collect it. I need that cash. I can't get that cash. I'm going to write that off because I don't want to get hit in the taxes from it. So how do we write something off? We debit this account called bad debt expense. Bad debt expense. Bad debt expense is an account, it's an expense account, which means it shows up in your income statement. Bad debt expense represents the amount that we cannot collect from our customers. Okay? Uncollectible for whatever reason. Customer died. Customer went out of business. Customer fell off the face of the planet. I've been trying to reach them. Their number's disconnected. They changed their email address. They moved. There's so many reasons why businesses can't collect from their customers. Tons of reasons. But whatever the reason, we debit bad debt expense. In this case, $520. And we credit that account receivable for that customer. Credit account receivable to reduce that account receivable because I can't collect it, right? So I got to reduce the account receivable for that customer. Credit account receivable, $520. And then the note is to write off a non-collectible account. Now, we can always change this if the customer shows back up. All of a sudden, Jay Kent wakes up and he goes, oh my God, I'm so sorry. I forgot to pay you. Here's your check. So sorry. Okay, once in a while that happens, right? We first wrote it off. Then all of a sudden, a couple months later, the customer randomly wakes up and goes, oh my goodness, I'm so sorry. I forgot to pay you. All of a sudden, they show up from the shadows, right? Oftentimes it's because I'm knocking at their door. Or it's because I sent someone to go break their legs to make a payment. Or whatever reason, right? They woke up. Great, wonderful. So thanks, Jay Kent. Appreciate you. I already wrote it off, but now I'm going to reverse that entering. To reverse it, it's called reinstating it. So I debit Jay Kent's account receivable, $520, and I credit bad debt expense. To reduce an expense, we credit the expense. So debit $520 to increase his account receivable back up to what it was before. And we credit bad debt expense to reduce the bad debt expense account by that amount. Basically, this is a reversing entry from the previous entry. Then we debit cash, $520. That's what Jay Kent's paying us. And then we credit the account receivable to reduce it, if you will, to record the payoff. Okay. Very good. Sorry.
Okay.
Yeah, go ahead, Nassim.
No, the harder question is when, if, when do you judge?
Yeah, when do you
Huh?
when
Yeah,
you know it's
like
a
when
bad
do you
debt?
figure?
That's a great question. Okay. So there's no there's no standard on this. Okay. So let's walk through an example together, Nassim. So let's say Nassim, you get a customer. It's been 30 days. You sent the late notice to the customer. Another 30 days goes by. So we're past due 60. Past due 60 shows up. Customer still hasn't paid us. Past due 90 shows up. Customer still hasn't paid us. Past due 120 shows up. Customer still hasn't paid us. Past due 180 shows up. Customer still hasn't paid us. It depends. It depends on a couple of factors. Number one is, let's say you made the sale September 1st. Well, your fiscal year for your company, maybe you follow the calendar year. So you start January 1 and December 31, which a lot of small companies do. So let's say you follow that calendar year. And it happens in 2021, September 1. You made this sale. September 30 rolls around. Customer don't pay you. Then October 31 shows up. Customer still don't pay you. November 31 show up. Customer still don't pay you. It depends on what your policy is. If your policy is 90 days past due, customer don't pay me, I'm writing that off. Okay. So the reality is, it depends on the company's stance on this. For most companies, usually 90 days, so 3 months goes by, no payment, no word, customer off the radar, time to write it off. And again, it depends on the company. Some companies can withstand the heat a little bit longer. So to answer your question, it depends.
Okay, two questions. Number one,
Go ahead.
this obvious. I think it's obvious, but I want to ask just in case.
Please.
If I'm in an installment account if I'm in an installment account and I pay every month, it's not a bad debt until I stop paying the installment, correct?
That's correct. Yep. Once you fall off the radar,
Okay.
it becomes a bad debt.
Question
Yeah, I
two.
had actually. Oh,
Go ahead.
yeah, just to piggyback on what you were saying, I just had the same situation a few days ago where this person did not pay us back to like now, and it's been like over a year. So we always have to hound them down.
Yeah, those situations come up, and you're going to have customers that simply won't pay you. You'll have customers that'll all of a sudden wake up and be like, "Oh my goodness, I'm so sorry. Here's some money." So you have to follow that same process. If you wrote off the bad debt already, you have to reverse it.
Question
But
two.
yeah, go ahead.
If I'm a company, let's say again, it's I'll pick on Lowe's this time. It's competitor.
Okay.
I don't know if this is against the law, but am I allowed to say, okay, I want because this is just my idea
Sure.
in my imagination for bad debt. If there are two people, let's just both call them J. Kent and J. Kent II. So there's no
Okay.
there's no bias. Okay,
Sure.
J. Kent 1 has a credit score of 760, whereas J. Kent 2 has a credit score of 400.
Okay.
I'm imagining that I may give a little more leeway to the J. Kent who had the 780 credit score than the one with the 400 credit score. So I may write him off maybe later because the credit score basically says his credit's better, correct? Or is
Yeah,
that against the law because I'm putting in bias?
it might be. I don't know. I don't know the answer to that question.
Like, how would you know their credit score? That would be the first
That's
question.
well, yeah, that's a good question. How would you know the
I'm a
credit?
company. I could find that out, right? Or no?
Well, not always, right?
Yeah, not always.
Because oftentimes the way it
Well,
works is,
if they apply for my credit, I should know this, right?
well, not always. So Nassim, you like a large company like a Lowe's or a Home Depot or whatever, they're not running it themselves. One of their partner banks is running those credit scores. Because oftentimes when you run a credit score, it has to be done through somebody who's licensed to do so. So oftentimes companies turn to banks in order to do that type of processing. But if you are running it yourself for whatever reason, let's say you're licensed to be able to do that, and you do run the score, I would not use that in practice. That's very gray area. Um, Often because what you're doing is you're creating bias. If you don't apply the same policy to everyone, there's a bias involved, and that'll open you up for lawsuits.
Yeah, and that's like an ethical thing too.
And it's ethical, yeah. So I would not do that.
That's why I was asking, you know.
Yeah. So the short answer is don't do that.
Okay.
Good question.
I'm just trying to wrap my head around like how a company can legally, obviously, and ethically, but like, I mean, I've heard of, the worst case scenario is someone dies and now you have to try to claim estate, and that's how you could try to claim a bad debt, because obviously a dead person can't pay off their debts,
Yeah, but the estate can.
and
Yeah,
now you have
if
to
there
go
is-
to the estate, blah blah blah. But
that takes years.
but but as you said, when you have someone just leaving the country and going off to Siberia, I mean, what are you going to do? I
You
mean,
can't hunt them down.
if he took my, yeah, good luck trying to hunt someone down in Siberia with my Lamborghini. I mean,
yeah, exactly. But the short answer to your question is ultimately, if somebody has a lower credit score than another customer and they both apply for credit and they both get credit, the one with the lower rate typically has a higher interest rate, and that's pretty normal. And so that's almost a form of a penalty for having low credit, in my opinion. But um, that's what a lot of companies do, though, is they'll be charged the higher interest rate to a ceiling price anyway.
but to me, that's even worse because that person can't pay it off anyways, and that person can say, "Well, to hell with this. I'm not going to pay it off anyways." I mean,
I
to me,
agree.
it's just sort of
It's a catch-22 in that
to me.
situation.
I mean, the ceiling makes more sense. Like the person with a higher credit score could have a ceiling of 10,000 versus a person with lower credit score with a ceiling of 3,000. Because that says if I lose 3,000, I'm okay with that person losing 3,000 because that person has a history of doing that. To me, that makes more sense. But to charge them a higher rate, I mean,
I know it's
what
not.
are you gonna? I mean,
That's
let's
what
just
banks do,
throw
though.
blood at their face while they're at it.
That's what banks do. So
I don't like I have a question, like even before all of this starts with that person have business with them, like wouldn't there be like a line, like a threshold the company would have when it comes to credit scores? Like if this person has, I don't know, 600 and below, they aren't qualified. If they have a 6 and above, they're qualified. Kind of like
also,
a threshold like that.
yeah, and that's true. That's oftentimes the way it works. Some companies don't have that type of threshold, but most do. So they're not going to issue credit to somebody who simply doesn't qualify based on those standards. Great questions. Interesting conversation. We do got to move on though. But please go ahead.
Oh yeah, Professor. So if you have like a customer who hasn't paid, right, over a year, so I mean, don't you have to like pay the taxes? How do you do that?
So no, and the reason why you wouldn't have to pay tax on that sale is through the bad debt expense write-off. When we're increasing a bad debt expense, we're increasing our expenses, which reduces the total net income. Companies pay taxes on net income. We don't pay taxes on revenue. We pay taxes on net income. So if our net income is lower due to a higher expense, I am in turn reducing my overall income, if that makes sense.
Okay, thank you.
You're very welcome. Great question. Okay, so using the direct write-off method, we're still in line with the revenue recognition principle, which requires expenses to be recorded at the same time the sales are earned. So in that process, I'm dating my bad debt expense in the same time period. So if it's within that same accounting year, I'm debiting bad debt expense. That's what that tells us. And it's consistent with the methods and other methods for allowance. Let's talk about the allowance method, which is the second way for bad debt expense. The allowance method is an estimate. So earlier you talked about Home Depot and Lowe's, huge companies, as you would imagine. And these huge companies, they have their own store cards. There is an expectation that will be a percentage of my customers who will not pay me. Okay, that's just business, right? You're going to have a certain percentage of customers that'll fall off the face of the planet, they'll die, something will happen, whatever, right? So we can't collect. So what does that mean? We estimate a percentage of our total sales that will be deemed as uncollectible. And this is a very common practice with very large businesses. So places like Home Depot, Lowe's, Macy's, Bloomingdale's, uh, Victoria's Secret. You guys threw great examples at me. All of these companies, they typically use what we call the allowance method, where they'll estimate the amount that will be recorded as bad debt expense. It's usually like 1% of sales, 2% of sales, 3% of sales. These are the percentages that we estimate we won't be able to collect. And of course, that will be adjusted at the end of the accounting period based off of our actual collections. So the first thing we do is we record the estimated bad debt expense for the period when the sales are recorded. And what this does is it reports accounts receivable on the balance sheet and the estimated cash to be collected.
Professor,
Yes, so please.
I have a question.
Yes, please.
So if we buy like the car, is more better credit or cash?
It's
Why everything here is supposed to be credit? If you don't have credit score, then you cannot get, you know.
Yeah, that's not always true either. So there's this thing called manual underwriting. Manual underwriting is a process by which you can still acquire a loan even without a credit score. What that requires you to do is you have to sit down with what they call a manual underwriter. A manual underwriter is an employee at a bank that has the ability to write a loan without a credit score. They use information such as your payment history, your total income, your total expenses, to then write a loan without the use of a credit score. So that's one option, is to go to a bank and talk to what they call a manual underwriter in order to get a car loan or a house loan or whatever. The other option is to pay cash. Because ultimately, you're right. If you go to a store or you go to buy a car or a house or whatever, if you don't have a credit score, it'll be near impossible for you to get a loan without manual underwriting. So that's why manual underwriting is always the best option in that case.
And they determine if you're eligible or uneligible when you do that?
Yes. Yep. Because they take all of your factors into consideration: your income, your monthly income, monthly expenses, payment history, how long you've been employed. They look at all of these factors to make a decision. That's what manual underwriting is.
Oh, I never knew that. Thank
Yep.
you.
You're welcome. Most banks have them. Good question. Great question.
Oh, Professor, one more question, please.
Yes, please.
So if in the company, right, someone paying with the card, right?
Uh-huh.
And at the end, they cancel the transaction. We're supposed to refund through the card, or it's okay? We just refund it through our cash.
So it depends. In most cases, it should be refunded in the form it was paid. So if I purchased it using a credit card, and then I cancel it, my refund should be back on my credit card. It shouldn't be through cash, because that will throw off your cash balance. So the refund should always come back in the way it was paid.
Oh, okay. Either we already give cash and we don't follow the process, the credit's still true to our business, right?
Yeah, yep. So that actually hits the business. That ends up hurting your cash flow when that happens. So what I would do in that situation is I would write it off through bad debt expense.
Okay, thank you, Professor.
You're welcome. Yeah, and that happens from time to time. I know exactly what you're talking about. I've been there. The same thing happened to me. Okay, let's take a look. So our company had credit card sales of $300,000 in the first year of operations. At the end of the end of the first year, $20,000 of my credit card sales remained uncollected. Oh, that's a lot. So $20,000 out of my $300,000 in credit sales, I can't collect on. They vanished. Something happened to those customers. Whatever, right? Based on the experience of similar businesses, we estimate that 1,500 of all of my accounts receivables will be uncollectible. How do we come up with 1,500, you might be asking? It isn't simply an estimate. It's based off of industry averages, it's based off of competitors, whatever. Oftentimes, you'll find if you just do a simple Google search, what is the average uncollectible accounts for a restaurant business or a retailer or whatever, based off the industry. There sometimes you'll be able to find industry averages. If you can't, we just use a rule of thumb. It's a percentage of sales. So in this example, we estimate a certain dollar amount, 1,500. So we would debit bad debt expense 1,500, credit allowance for doubtful accounts. It's a new one. So allowance for doubtful accounts is the account that we would use when we're estimating the amount that we will not be able to collect from our customers throughout the year. On the balance sheet, we have under current assets, we have cash, accounts receivable, inventory. Those are all current assets, right? Accounts receivable specifically is, as you know, the amount that we expect to receive from our customers but have not yet received it. That's what an accounts receivable is. So if we estimate that we will not be able to collect a percentage or a dollar amount of our accounts receivable, we would simply deduct it from our accounts receivable using the allowance for doubtful accounts. Allowance for doubtful accounts is an asset account. Yeah, you heard me right. Allowance for doubtful accounts is called an asset account. However, it is what we call a contra account. Contra account. You heard me use that term several weeks ago. I used the word contra. The word contra means contra flow. It holds a negative balance under current assets. It's simply a method for us to reduce our accounts receivable without actually touching the accounts receivable account. It is a contra account to accounts receivable, the allowance for doubtful accounts. It holds a negative balance. So we take our accounts receivable minus our allowance for doubtful accounts to give us our total accounts receivable. Oh, Jay Kent, this guy, he just keeps showing up, not paying me. What's up with this guy? Okay, so Jay Kent, again, January 23rd, he purchased $520 before this. We realized that Jay Kent, he ain't gonna pay us. So we debit allowance for doubtful accounts $520, credit Jay Kent account receivable $520. This writes off an uncollectible account. And someday that guy better pay me, I tell you what. So before the write-off, we had a total accounts receivable minus allowance for doubtful accounts gets me realizable accounts receivable 18,500. After the account receivable, my total account receivable, $19,480, minus allowance for doubtful accounts, $980. That just shows us the change, right, from the $520. Okay. Debit. Now all of a sudden, Jake kind of shows back up out of nowhere, like the next year. Okay. Jay Kent shows up. Oh, I'm so sorry, I forgot to pay you. Yeah, Jay, I mean, bruh, you owed us like months ago. Where you been? So we debit accounts receivable to reinstate his account. Credit allowance for doubtful accounts, $520. We debit cash, $520. Credit account receivable, $520. He showed up and paid his bill. Amazing. That guy kills me. Okay. So there are two methods to estimating your bad debt expense. One is the percentage of sales. That's my favorite one. It's the easiest one. The other one is through the aging of accounts receivable report. I'm going to show you a new report. It'll be fun, I promise. Percentage of sales. Very simple. You take your current period sales, your month, your year, whatever. We multiply this by the bad debt percentage. This is the percentage that we expect we will not be able to collect. This gives me my total estimated bad debt expense. So in our example, we're going to say we're estimating that we won't be able to collect 0.6% of all of our credit sales. We have a total of $400,000 in sales that we made on credit. So you take your total credit sales, multiply that by the percentage that you expect you won't be able to collect, 0.6%. This gives me a total bad debt expense, $2,400. At the end of the year, I debit bad debt expense, $2,400, to increase my bad debt expense, and I credit the allowance for doubtful accounts, $2,400. As a reminder, the allowance for doubtful accounts is an account that we use to estimate bad debt expense. That's like probably my favorite method. It's the easiest, yeah. So at the end of the year, we have year-end accounts receivable times bad debt expense. Total estimated bad debt expense minus the previous balance in the allowance for accounts equals the current bad debt expense. We have 50,000 in credit sales, 200 in our balance. 5% of receivables are going to be uncollectible. That's high. That's high in my opinion anyway. We made 50,000 in accounts receivable times your 5%. That's $2,500 that we will end with our allowance for doubtful accounts. You can see that and this is obviously based off of the current year information. And because allowance for doubtful accounts is an asset account, it maintains a regular balance. And it carries from year to year. And the reason for that is because sometimes your customer might come back the following year and actually pay it, right? So we have something for it to go against. Okay, aging. The idea of aging is it tells us how long something is past due. Aging. It's aging. It's getting older, right? The longer it's past due, the older it is. So let's talk about this real quick. We classify receivables by how long it's been past due. So 0 to 30, 31 to 60, 61 to 90, 91 to 120, 120 to 180, 180 plus, right? And then you go all the way to the end of the year, 365 if you really want to. But typically, it's classified based off how long it's past due. So 0 to 30 means it's within the past due 30 days. 31 to 60 that means the receivable is 31 to 60 days past due. 61 to 90, it's 61 days to 90 days past due. Right? These are the categories. We group them and multiply by the estimated bad debt percentage to give us the estimated bad debt percent for each age group. We estimate the total of bad debt expense by adding all of those together. So here's how it looks. So here are all my customers on the left side here. I got a total of $50,000 that my customers owes me in total receivables. I estimate that I won't be able to collect $2,270 of that. Now, how did I come up with that? First of all, I expect not to receive 2% of all of my collectibles. Okay, that's a good estimate. When it becomes 1 to 30 days past due, I expect I won't be able to collect 5% of that category. When it's 31 to 60 days past due, I expect I won't be able to collect 10%. 61 to 90, 25%. Over 90 days, I won't be able to collect 40%. We can see that the older the account receivable becomes, it is less likely that we will collect it. Based off of that, we estimate what percentage we won't be able to collect. We multiply that percentage to the total receivable for that category, for that age group. And that will give me my estimated uncollectible amount for each age group. I add up all of my age groups, not do yet 1 to 30, 31 to 60, 61 to 90, over 90. I add up all those. I got my total estimated uncollectible amount. And that I would debit bad debt expense, credit allowance for doubtful accounts. So first one to do is determine your current balance. Step 2, determine what the account balance should be. Step 3, make adjusting entries for steps 1 and step 2. In other words, all you're doing is this process. You're multiplying each age category by your percentage of uncollectible estimate times the total balance. Get you your estimated uncollectible amount for each category. Add all those up to get your total. And that's the method for using the aging of accounts receivable. It's probably the most accurate, in my opinion, but it's more difficult to do, right? That's why I just like the percentage of total sales.
So,
Go ahead, Nassim.
stay on the slide. It's okay. It's okay. If a person, you're still in the pay period, and all of a sudden one of your customers at 32 days past due,
Mm-hmm.
the reason why that person that customer was past due was because he or she had a customer themselves who was past due and could not have the cash to pay you.
Yeah, that happens all the time.
Remember, you're a company that. Okay, so let's say they're past due, and we put it at 10%, and they all of a sudden pay you. That means you'd have to go back to your balance sheet, right?
Mm-hmm.
I would debit the. Oh my gosh! Give me a second. I would debit the account receivable and credit the bad debt. Excuse me. I would debit the allowance for doubtful accounts
to reduce the allowance for doubtful accounts.
And I would credit the right. Then I would credit the.
You already said it.
Give me a second.
Okay.
I'm using. Okay. I would credit bad debts expense. I'm basically undoing.
You're undoing it.
The
That's
reporting,
right.
Correct?
That's right. Yep.
Okay. Then I would credit cash. And then
cash.
debit the debit cash and credit the accounts receivable, correct?
That's correct.
And then I would have to go back and reassess the percentage based on the loss of the receivable on 31 to 60, correct?
That's right. Yep.
I have to readjust my estimated uncollectible.
The percentage will probably remain the same for the rest of your
Oh,
customers that are in that
not the
category.
percentage, not the percentage, but the estimated uncollectible
Yes.
would
that-
change.
Yes, that would change because your total receivable would change.
Okay,
That's right.
right. Just for that balance sheet period, correct?
That's right.
Okay, thank you.
You're welcome. Yeah. Great question.
Professor, I have a question.
Yeah, go ahead, Marina.
So the process of the estimated uncollectible,
Mhm.
would this be something now with system? Is there a system that does this automated now and not doing it manually like this per se?
Yeah, QuickBooks does it. A lot of the softwares do it now. Yeah.
Okay.
Good question. Yeah, because manual, let me tell you, it sucks. Running that through a spreadsheet is not fun. Let me tell you. I've done
Yeah.
it so many times. Great questions. So, so with Nassim's earlier question, yeah. So we would have to make adjustments. So let's say the customer shows up, they're in 32 days and they show up and they pay us, right? So we have to go through the process of making the adjustment, debiting bad debt expense, credit allowance, or doubtful accounts, and then reversing course, reversing the entries. So this just kind of summarizes what we went through. Comparing the two processes for estimating bad debt expense. You go through the percent sales, which I like because it's the easiest, or you could go through the process of the aging receivables. But yeah, it's fun.
One more question.
Go ahead. Yeah, Nassim, what's up?
One more question. This is going back to ethics.
Sure.
In business. Should if when I'm estimating bad debts, am I allowed to visualize or interpret a publicly traded company versus an individual customer?
What do you mean? Can you give me an example?
So if Jay Kent came and said, "Oh, I got your money, and I'm like, "Oh, how will I know that?" Versus if I am Payless and the manufacturing company that or let's say I'm the manufacturing company at Payless and Payless says, "Oh, I got your money." We need to just get, their accounting department saying, "We have your money, we need 30 days." Like, should there be more or less of a trust to a publicly traded company versus a customer, or should they be viewed equally?
They should be viewed equally. That's how I would view them both equally because going back to ethics, right? So I have as much faith in a publicly traded company as I do an individual. They can both lie to me all day long, or they can both be very honest with me all day long. And that goes back to independent judgment. So I would never penalize an individual over a publicly traded company for that reason, because I take everything they say at face value. If you tell me, like, let's say, Nassim, you borrowed money from me, you say, oh, Dr. B, I got your money, I got your money. Well, I don't know you got my money or not. I'm trusting you and saying that you have it and that you'll pay it. And then when you don't, I take you to court and go through the process. But but I would do that the same way with a publicly traded company as I would with an individual customer. So to answer your question, you really should view them both equally. Good question.
Thank you.
Yeah, absolutely. Yeah, good questions. I like that stuff. All right, note receivable. Let's talk about notes. A note is basically a loan. Here's how it works. Customer didn't pay us for a while. Right. They fell off the radar. Jay Kent, that guy, right? Jay Kent fall off the radar. I contact Jay Kent. He finally answers the phone. Jay Kent, bruh, you're 90 days past due. Here's the deal. You're going to pay me. And not only are you going to pay me what you owe me, I'm going to charge you interest. So we're going to create a promissory note that guarantees you will pay me by this certain date and with a certain interest. And who's guaranteeing it? This bank. Okay. We call that a note receivable. We're converting the account receivable to a note receivable. The way we do that is we take it out of accounts receivable and put it into notes receivable. And we attach an interest rate because now it's a note. It's a loan, basically. And so that loan comes with this thing called a promissory note. The promissory note is a promise to pay. Okay? It includes things like the amount, the date, when it's due, who it's being paid to, the interest rate, and who's paying it. It's a promissory note. I'm sure those of you who have student loans, you know what that is because you've signed one. Okay, maturity date. Maturity date is when the note is due, when it must be repaid. That's what a maturity date is when it's due. That's what we call a maturity date. It is now mature. That means I'm paying the principal plus interest. That is the maturity date. That's when it must be paid. In this example, we have $1,000 note, 90 days, 12% interest. 90 days is the maturity. Okay? In other words, this is a 90-day loan. You have 90 days to pay me $1,000 plus 12% interest. That's how we read this. $1,000, 90-day, 12%. We have the face value, we have the time period, and we have the percentage interest. So what we do to figure out the interest, let's walk through it. It's due October 8th. How do I know it's due October 8th? It was made on July 10th. 90 days. 90 days. How do we compute it? How do we figure out how much the interest is going to be? It's the principal times the annual interest rate times the expressed in fraction of year. Okay, here's how it looks. It's just toward the bottom of the slide. Principal is $1,000. The interest rate is 12%. The fraction expressed in a year. 90 days divided by 360. Now I can already hear you, Dr. B. There's 365 days in a year. I know that. You know that. There are 360 banking days in a calendar year. That's why we use 360 in accounting. So 90 over 360 banking days in a year. So that's $1,000 times 0.12. 0.12 is 12%, by the way. Times 0.25. 0.25 is 90 divided by 360. It's 0.25. That equals a total interest to be paid of $30. So on that, when it's due, on its maturity date, I should be receiving $1,030. So on July 10th, I made the conversion to the note receivable. So debit, note receivable, $1,000. Credit sales, $1,000. October 5, this is a different example, it looks like. Hold on. Oh, that's if it's past due. Yeah. Debit, note receivable, $1,000. Credit sales, $1,000. Let's record it. Let's say it's past due. Okay, we had a company that agreed to accept $232 in cash along with a $600 60-day no payable. In other words, I'm accepting two forms of payment here. One's a note that the customer will pay us in the future, and they're also paying us cash for a sale that we made, I guess. So we debit cash 232, debit note receivable 600, credit account receivable 832. What this shows us is the customer didn't have enough to pay us what they owed us up front. They're giving us a little bit in cash, and the rest we're converting it to a note receivable. The note receivable is for 60 days with, oh my God, 15% interest rate for that 60-day note. Which, yeah, it's a little high, but it encourages them to pay it. Okay. And it's kind of a penalty. So they pay us. We debit cash, $6.15. $15 is the interest, right? 15%, 60 days. Well, if we go through the formula, right? The face value times interest rate times 60 days over 360 banking days gets us to $15. So we debit cash $6.15. We credit note receivable $600, and we credit interest revenue $15. As a reminder, interest revenue account is a revenue, looks like a sales account of 15, and that we're receiving $15 in interest. Okay. Great. What else was I going to say? Oh, the interest, yeah. So the interest part, let's talk about that. We accept a $3,000 60-day note, 12% interest from a customer for a past due account. When the accounting period ends in December, we need to go through our adjusting entries, right? We're closing our books for the year. We need to account for the interest that we would receive for that year, right? So we debit interest receivable, $15, and we credit interest revenue, $15. What that does is it records the accrued interest for those days within that year. Just like any other closing entries or end of period adjusting entries that we make.
I have a question to ask you.
Yeah, go ahead, Mark. Yeah.
So with this one right here, the one you're on right now.
Yeah.
So let's say, for instance, the 3,000 that this company owes you,
Mm-hmm.
times 12% times 60 over 360.
Mm-hmm.
So the person is paying you back the cash of $3,060.
Yeah. So I charged interest. The face value is $3,000. So I'm receiving the face value plus the interest. So that's why we would debit cash $3,060, because we're receiving both interest and the face value back.
So the interest is 12%, correct? Am I following you correctly?
That's right. Yep. So
Okay.
Yep, you got it.
So, because I was taking notes while you were talking, but you went to another slide, so I had to go back. I got you.
Sorry about that. Yeah. Great. Good question. Okay. So receivables. Companies can convert receivables to cash before they're due. So, for example, customer pays us before it's due, right? We debit cash. We debit a fee expense, like a factoring fee expense. We credit accounts receivable. This is rare. This is very rare. Okay. What this does basically is it adjusts for the difference in days. So if a customer pays us before it's actually due, oftentimes the full interest isn't going to be charged because there's certain days that they don't need to pay us the interest on if they pay early. Which is why I always recommend that you pay something early if you owe, because you won't be charged the interest for those days. An example would be, let's say you have a credit card, and the credit card compounding interest is 21%. 21%, that's 21% a day, right? So if you pay, let's say you owe $1,000, it's 21% interest. So $21 additional per day of interest, right? So if you pay it before those 30 days from receiving the bill, you won't have to pay the interest for those days that you paid it early. You see what I'm saying? So you pay less interest over time. That's a good practice, you know. Okay, quick ratio, and then this chapter's just almost done. We have what we call accounts receivable turnover. Accounts receivable turnover shows us how quickly we're converting our accounts receivable into cash. Okay, how long each account is staying in accounts receivable. And to do that, we take our total net sales divided by our average account receivable. To find the average account receivable, you could take your beginning balance plus your ending balance divided by 2. That gets you your average account receivable. Okay. Comments, questions, or concerns before we start the next chapter? You all with me? Okay. All right. Let's stop this one. We'll start the next one.